According to AIQ Asset Management and LPL's research team, stocks defied the skeptics in a very unpredictable 2023. The Dow Jones finished at an all-time record high on December 28th, and the S&P 500 came within a whisker of a fresh all-time high after the index rallied more than 20% for the year. It wasn't only stock investors who had plenty to cheer about. Bond portfolios, which struggled mightily along with stocks in 2022, staged a furious late-year rally. Bloomberg's broad bond market benchmark returned a solid 5.5% for the year after being negative year-to-date as late as October. Last year was especially gratifying given the pessimism at the outset of 2023. It also offers some important lessons for investors. Number one being, don't always follow the herd. They're right at times, but wrong more often than you think. As recently as May of 2023, Wall Street strategists forecasted a price number of 4,017 for the S&P 500 at year-end, about 19% too low. Stocks rise about 3 times as often as they fall, so be wary of bearish herds. Number two, consider cycles and trends. Stocks rarely fall 2 years in a row. Year 3 of the 4-year presidential cycle, for example 2023, has been the best over time. Bear markets tend to recover losses in under a year in the absence of a recession. The last bear ended in October of 2022. Historical cycle averages point to mid to high single-digit gains for stocks in 2024. Number 3, don't bet against the U.S. consumer. Every economic cycle is different, but the post-pandemic recovery distorted the economy such that the traditional economic indicators misled many economists. One takeaway here is stimulus matters. For example, low interest rates, stimulus checks, student loan forgiveness, and even infrastructure spending. Another takeaway is that consumers with jobs will spend. The unemployment rate remains near 50-year lows. And finally, number 4, focus on the long term. This can't be stressed enough, but this unusual economic cycle made it extremely difficult to predict where stocks were going, reminding us that time in the market is a better mantra than timing the market. Waiting it out through the down periods, even through wars, a banking crisis, and widespread calls for recession is the best approach for nearly all investors over time. These are all great lessons to take away as we turn to 2024. The year may not bring quite as much joy to your portfolio, but with inflation coming down, unemployment still low, corporate fundamentals in good shape, and the Federal Reserve poised to cut interest rates, the ingredients for another profitable year are in sight. And other than that, that's it for your market recap. If you have any questions, feel free to reach out anytime. And as always, thanks for watching.